Hi everyone, thanks for tuning into my channel, All Things Accounting. Today, what we're going to be going through is depreciation, in particular, straight line depreciation. So stay tuned and we will get through this together. Depreciation. What exactly is it? So under the matching principle, under generally accepted accounting principles, we have to match the expenses with the related revenue for which it was incurred to help generate. So here, for example, if I have a consulting business, my vehicle I use for my consulting business, the easiest way to calculate depreciation would be straight line. So we'll go through an example of that on the whiteboard. So it's very simple calculation, but it's a way for businesses to satisfy the matching principle at the same time. So let's go on inside and we'll go through the whiteboard and we will go through a numerical example. Okay, so follow me. Okay, so we're in the whiteboard. So let's go through some details about the depreciation straight line method, okay? So certain key things that to keep note is that it's used to write off fixed assets, gradually, okay? And it's you could also call fixed assets tangible assets, okay? So it's to write off fixed assets gradually by a set amount, yearly or monthly. Okay. For fixed assets, we would call it depreciation. For intangible assets, those assets that you cannot physically touch, so they're intangible. So for that, we would call their depreciation by a different name, and it's called amortization. All right. So like we said before, this is the easiest method to calculate depreciation. So there's going to be a depreciation expense that's going to hit the income statement, okay? Because we want to match the expenses with the revenue for which it was incurred to help generate in the same accounting period. So the depreciation expense remains consistent throughout the accounting period. So when we calculate that, it's going to be month after month, it's going to be the same amount. So that's why it makes it easier. It also helps it easier to predict what your expenses are going to be in the future, and helps you with your budgeting because you know the amount already. So if we look at the formula, we can come up with a formula where it is depreciation expense is equal to, so in this case, it's the asset cost, and it would be the total asset cost minus an estimated salvage value all over the estimated useful life of the asset. Okay? So that would give you the estimated useful life. If we want to look at that in years, if we wanted to calculate per month, then we would take whatever we calculated here as the depreciation expense, that would be on a yearly basis, take that number and divide it by 12, and therefore that would be equal to the monthly depreciation expense. If, for example, it was not over a whole year, say there was only 9 months of the year that we're accounting for, then you would do what we call a proration. So you would prorate it, and take this amount, the number, times, say for example, if it was starting in April 1st, that would be 9 months. So you would multiply that by 9 out of 12 to give you your amortization for that part of the year, 9 months out of 12 that you had the depreciation for. So relative to other depreciation methods such as the declining balance or double declining balance, in this case, it's, as we mentioned, it's more consistent. Therefore, there's going to be fewer errors that can be made. So let's go through a numerical example. So normally what we would first have to do is first step is to calculate the final cost of the asset. Now I'll elaborate that now. So the final cost should include the base price. So it should include the base price plus any applicable taxes, all right, plus any delivery fees. So that would give us the base price plus taxes plus delivery charges would give us the final cost. So that final cost is what we're going to be utilizing in our computation. Now the second step, the second step is to calculate and subtract the salvage value. So calculate and subtract the salvage value from final cost. Now, there could be some judgment involved in calculating the salvage value. It's not an exact science by any means. Here, salvage value, what do we mean by salvage value? What it is, it's the amount that we expect the asset to be worth at the end of its useful life. Okay, so I'll repeat it. Salvage value is the amount, the dollar amount that we expect the asset to be worth at the end of its useful life. So if we go through an example here, and let's say that I bought a photocopier, okay, and I bought it for a base price of $7,500. Now, applicable cost to ship it would be $150. So this is the base. This is the shipping cost plus the applicable taxes in this case. Let's say that they're $600. So this would be tax. So the total cost, the final cost would be $82.50, let's say. Now, if we were to say that the estimated useful life were to be approximately 5 years, and again, that comes with judgment, the salvage value let's say that that is going to be deemed at $1,500. Now we have all the information necessary for us to calculate. the straight line depreciation. So coming up with a salvage value, again, like I had alluded to, it's not an exact science, but you want to be conservative. Say, for example, in 2020, you bought a $25,000 vehicle for your business. After 5 years, you could estimate the salvage value to be approximately $6,000. Okay? If you were to estimate it to be about 15, then that would be much too aggressive. Some examples of useful life for other things would be vehicles and office supplies tends to be about 5 years. Furnitures and fixtures tend to be about 7 years, and tractors and other livestock, we can estimate that on average about 3 years. So here, let's calculate the depreciation expense. So depreciation in this case, depreciation expense on an annual basis would be equal to $82.50 less the estimated salvage value that we mentioned before of $1,500 over 5 years. So that would yield, if we calculate it, $1,350. So if we were to make a journal entry, assuming for the entire year, so it would be, let's say, assuming that we have a calendar year end, December 31st, we would debit depreciation expense and credit accumulated depreciation for $1,350, and we would have the explanation under here. So notice the accumulated depreciation is a contra asset account. This would hit the income statement under the expense, and this would hit under the asset, subtracting from the value of that asset is a contra asset account, which reduces the value of that particular asset. So I hope this example of straight line depreciation helps, and it provides a little more clarification for you. So I hope you can subscribe to this channel. Please remember to hit that like button and hit that bell notification icon so you could be always up to date with the new videos and tutorials that I will be posting. Until next time, take care.